prices post third straight week of gains amid the fresh threat to supply emanating from Libya, even though the EIA reported yet another week of weekly rise in crude inventories. U.S. economic data continues to impress after steady jobs report indicating unemployment benefits falling to a 49.5-year low. The March producer prices increased by the most in 5 months. The FOMC minutes indicate the central bank will leave the door open for more rate hikes should the need arise, signaling a dovish stance. El Nino worries seem to have eased. A robust monsoon is likely. That's the word from the Met Department coming in from the Times of India. This after the U.S. weather agencies last month have already flagged off a 60% chance of El Nino continuing through the summer season. Well, that's all that we've been tracking for you on this week's news of commodities. Hello everyone, I'm Mubina Kapasi, and let's kickstart the discussion first up by talking about what exactly is the precious metal space up to, given the fact that we had a whole host of cues, starting off of course first with the jobless data from the United States, which certainly was a very strong one, and we did see gold prices fall in the beginning of the week, but subsequently they did manage to recuperate on the back of a weaker dollar, and of course not to mention a very dovish Fed as well. However, once again, U.S. economic data did play dampener for precious metal bulls, because we did have the producer price number that came in very strong, and hence you did see gold prices crack again. But nevertheless, NSE's gold and silver market on today's trading session managed to hold on, snapping many days of a losing streak. So NSE gold and silver in the cream. But I think the big headline has also come in from crude prices. It's the third straight week that we are seeing gains come in from the liquid gold. $71 per barrel conquered for Brent, once again the highest level since November 2018, and WTI as well was about 65. However, some profit booking kicked in over there this after the EIA reported that inventories have once again built up. In fact, last week's inventories built up to the tune of about 7 million barrels. So that is something that perhaps did have a bearing on WTI, but Brent, however, did power ahead very, very smartly. And look at the sort of rebound we witnessed from December lows of just about $55 per barrel. It's more than a 40% rebound. So safe to say it's firmly back in bull territory. One reason for this is, of course, the new supply threat that's emanating from Libya, where currently there's a clash between the government and militants, and of course it's heading towards Tripoli. Libya, of course, being a major oil-producing nation as well, it has naturally spooked fears among the markets that, hey, there's yet another supply threat emanating apart from, of course, the existing sanctions on Iran in Venezuela, where as well output has been declining, and how. Well, we discussed all of this earlier on with Vandana Hari. Listen in to an excerpt of that conversation.
All the reasons for the rally so far, and I'm just going to try and crystallize it, are valid, okay? So there's three things. That's fear, fundamentals, and euphoria. Fear as to what happens to the production of Venezuela, Libya, and fundamentals is what Venezuela, Libya, and Iran as well, of course. Fundamentals, OPEC has been tightening the market. It's been over-tightening the market. There's absolutely no doubts about that. Euphoria, I call it euphoria because I think probably it's a little bit overbought over the optimism that China and the US are going to have a trade deal. I call it euphoria because, you know, there are the question marks. You know, how much is it really going to prop up Chinese economy, and how much is it going to support Chinese oil demand growth? So these three factors, they are very supportive, but, you know, not all of them are going to continue supporting the rise of crude from here. That's what I believe. Three things, or three reasons I would give for crude not continuing to rally from here, okay? You just need to remember Trump, Putin, and the economy. So I keep mentioning Trump, but look, I'm not being facetious. The US president does not want prices to go up. Now, there's arguments as to why not, because, you know, he benefits, the shale industry benefits, US exports benefits, but I think has more of a populist approach. He's looking at what price the American drivers are paying at the pump. And as it approaches $3 a gallon mark, which is sort of like psychological level for them, he doesn't want that. So he'll continue pressuring. And it's not just tweets. Again, you know, if his tweets are not having an effect on OPEC anymore, don't think that that means prices will continue rising. He'll pick up the phone to King Salman. I mean, he just had a phone conversation with MBS, right? He has leverage on the Saudis, especially after the Khashoggi incident of last year. You know, they have to listen. And it's a lot of politics. So officially, you know, you might see the Saudi oil minister saying, no, you know, we'll do what we want to do. But who knows what goes on behind the closed doors, right?
So you're saying crude prices will be under check irrespective of what?
Yes, and exactly. And Putin, why I mentioned Putin is that Russia has become the sort of voice of moderation, the balancing force. And the Saudis, I think, are being extra bullish, extra hawkish with regard to oil prices because they're having to counterbalance Russia. Chinese economic growth had been slowing down. There was deceleration even before the tariffs war. And that looks like, you know, from all the experts, people I speak to who do business in China, who are based in China, and the view from the ground. So again, you have to be careful, you know, not that there's a political view from Beijing. The view from the ground is that China is in a lot of trouble. So look, Chinese oil demand is still the single biggest contributor to global oil demand growth. It will remain so. But the worry here over global oil demand growth is if Chinese growth is moderating, you know, how much, yes, Indian growth is there as well, but let's compare. China consumes close to 12 million barrels per day. India is close to a third of that. So in absolute terms, India growing even at 4.4% is not adding that much. So these are very real concerns. China is also cracking down on debt. It's cracking down on pollution, which is closing a lot of you know, factories, industrial, you know, smaller companies, which
crude consumers.
Exactly. So Chinese oil demand may grow 3%, you know, which is it's a strong growth compared with the rest of the world, but it's not as strong as we've seen in the previous several years.
You know, we've spoken about the US extensively, then there's OPEC, and they've been going ahead and cutting output. What is your expectations now from OPEC in the June meet?
Yes, very interesting. So the new dynamics that we have seen emerge since last month, there was a ministerial monitoring committee where both the Saudi and the Russian oil ministers were present, and the oil market focus zeroed in quite a bit on the differences in their outlook. Look, I think I wouldn't make too much of that, and I certainly wouldn't say that that means that the group is going to split up. I keep saying, and I'll say it again, I think it bears repetition, that I think the collaboration, the cooperation is here to stay, okay? All the producers within OPEC, as well as the non-OPEC allies, have seen the difference to their economies, their revenues between 2014, 15, 16, and what happened after 2017. So that's here to stay. However, it seems to me that the Saudis have become a bit hawkish. They want prices on the higher side. Not their production costs are fantastically low, okay, but their budget price is way higher. So they want, you know, some say 70, 80, but that's the sort of ballpark the Saudis would like. The Russians can make do. There's a much more diversified economy, much less dependent on oil. They can make do with lower prices. And even back in 2017, when Brent started first climbing into the 60s as a result of the cuts, the Russian oil companies were, you know, knocking on the doors of the oil minister and saying, let's just get out of it. We are happy. $60 is good enough for us. Let's just get out of it. Importantly, Russia did not get out of it. Okay, the Saudis and the Russians are collaborating far beyond oil. It's a very strong commercial, political partnership.
Well, that, of course, was Vandana Hari right here in our studios talking about the prospects for crude, which has already run up quite a bit this year so far. Well, we'll take a very short break right here on the show, but coming up next, we'll be discussing what are the prospects for sugar in India and, of course, even the global glut situation. Will that be assuaged on account of the upcoming El Nino situation? Stay tuned for more on that. Welcome back. You're watching Commodities First right here on ET Now. The next topic that we are going to discuss has to do with sugar. Reason being, we do have an El Nino-like situation that may be developing. In fact, US weather forecasting agencies have said there's a 60% chance that situation could develop and continue throughout summer, which naturally has cast a gloom of doubt, drought and whatnot, especially among the sugar cane growers in Maharashtra. In fact, reports suggest that Maharashtra sugar production could tumble down to a 3-year low from the 1st of October onwards, only seen at 8 million tons. Now, of course, do remember that the current sugar scenario is that there's a huge glut. So will this help ease that glut? Let's discuss this and more with Avinash Verma of ISMA. Avinash, thanks so much for joining in on ET Now. I want to first up understand from you, in the past as well, when we have had this entire El Nino situation develop, though of course the last 2 years have been great in terms of monsoons, but before that, when we have had this monsoon deficiency, and given the fact that India as a country is largely dependent on monsoon, what has been the impact on sugar growers and sugar production?
See, if you really ask us about the impact of weather and rainfall on sugar production in India, our experience has been that it has largely affected the western part of Maharashtra and northern part of Karnataka, which happen to be large sugarcane growing beds. It does not really have a very big impact, say, in the northern part of India, which have good irrigation system and good water flow there. It does also impact Tamil Nadu, but Tamil Nadu generally does not produce so much of sugar as much as Maharashtra and North Karnataka. Now, talking about next season, we will have to remember that Maharashtra suffered a bad rainfall and a deficient rainfall last season also, because of which the reservoirs in Maharashtra do not have enough water availability now. And therefore, the sowing of sugarcane has not been good in Maharashtra in the last about 8 to 9 months. Now, on top of that, if the El Nino is going to impact the rainfall from June to September in 2019, which plays a major part in not only the productivity of sugarcane in the field, but also the sucrose formation, which gives us better sugar recovery from the same quantity of sugar cane. So therefore there might be a double whammy. Number one, the sugar cane sowing is already low in Maharashtra and North Karnataka as compared to what is available this season, as well as the lower rainfall is going to impact the yield and the recovery, which is going to reduce sugar from the same sugar cane that we're going to have in the next season.
All right. So given the possibility of El Nino and also the fact that, like you mentioned, the acreage sown for sugarcane has been low for the last 8 to 9 months, would it be a fair assessment to say, as reports have been suggesting, that sugar production in Maharashtra may actually go down to only 8 million tons from 1st October to the end of the year? That's almost a 3-year low.
I would not like to give you a number as of now for Maharashtra or Karnataka or any part of the country, because ISMA does its satellite imaging of the sugarcane area and a detailed analysis sometime in July, and a very firm or a better idea we would get sometime in September when we do our second satellite imaging. So whatever numbers are coming out in the market today, I would at best say that it is almost a guess. We will give you a better number sometime in July and September 2019.
Connect with you then as well. But Mr. Verma, one thing is clear, that the production trend is going to be lower than what it was last year for the reasons that you mentioned earlier. So do you think, or to what extent would this play a role in sort of reducing the glut? Because we've had world over countries like Brazil especially complain about the fact that India, on account of the subsidies, etc., has been a major contributor to the global glut situation in sugar. To what extent would this essentially help in reducing the glut situation or keeping it in control?
Yes, I mean, very important to understand this aspect. I mean, there are 3 or 4 components that I'll try and explain. Number one, we will be starting the next season as on 1st October 2019 with a very high opening balance, never ever recorded in the history of the sugar industry in India. We expect the opening balance to be around 13 to 13.5 million tons, which is almost about 8 million tons more than what we actually require to carry into any season. That is number one. Number two, the next year's production will be lower because sugar cane availability, as we just discussed, in Maharashtra and North Karnataka will be lower than the current season, and therefore we expect that the sugar production from this part of the country will be lower. How much lower, whether it's going to be 2 million tons lower or 4 million tons lower, as I mentioned, we will discuss that sometime in July or September 2019. Thirdly, and quite importantly, we should know that the government has supported the ethanol program in India very strongly, very aggressively. And we are seeing a lot of capacities getting developed for ethanol production over the last about a year. So therefore, next season, we expect this extra capacity of ethanol production to help us divert more sugarcane away from sugar into ethanol, which means, and we expect that from the current season, when we are expect to divert about 4 lakh tons of sugar into ethanol, next season we can divert anywhere about 1.5 to 2 million tons of sugar away into ethanol, which would further reduce the sugar availability next year. So just to summarize, we will be starting the next season with a high opening balance, about 13.5, but lower sugar production because of lower sugar cane, and also lower sugar production because of diversion into ethanol. Now let us look at the world scenario. You mentioned that yes, Brazil is diverting some sugarcane into more sugarcane into ethanol. And if the current crude oil prices remain at these levels or move up, we expect Brazil to continue to do the same next season. This year they diverted anywhere around 64 to 65% of sugarcane into ethanol, which meant that lower and lower sugar production was available. Next season, we already know that European Union has reduced its beet production. Pakistan does not have surplus next season. So these two very important exporting countries in the current year will not be exporting next year. We are also seeing Thailand having a similar impact on their sugar cane, and therefore the Thailand also should be producing less sugar cane and sugar next year. So overall, experts believe that internationally the sugar surplus, which is about 2 million tons in this season, will be about 4 million tons deficit next year. So a fall of about 6 million tons of sugar production next season, which gives that opportunity to India to export some of its surplus availability or some of the stocks that we will be carrying into the next season. The prices might be better than what it is currently, and therefore India should be able to export some more sugar in a much better fashion or faster than what we could do this year.
Okay, fair enough. That's a very interesting trend that's really catching up, diverting the production towards ethanol, as opposed to sugar. And I think that, like Mr. Verma said, it was just 4 lakh tons, and now it's expected to jump up to more than 1 million tons. It's a very interesting trend and a very important one as well. Avinash, thanks so much for joining in and helping us understand what could be the possibilities or rather the implications of a possibility of a lower sugar production in light of a monsoon that this time around is not expected to be that good. Well, watch out for sugar prices, watch out for sugar companies as well. But it's time to get you some technical recommendations then. And we have with us our technical experts as well for the same joining in, Sugandha Sachdev. Hi Sugandha, what would be the commodity strategies you'd recommend for the upcoming week?
Hi, good morning. I would recommend going short in gold prices. If you see gold prices, we have seen a hefty fall in the previous session, though prices have shown some recovery in today's session. But then the safe haven appeal of the gold has been dented because you've seen a sharp rise that has come in dollar index because of the upbeat economic data from the US, be it in the form of weekly initial claims data, which has fallen to a 50-month low. So that's actually boosting the dollar index and suppressing gold prices. Also, in terms of the levels, gold prices have not been able to nudge past the key resistance of 1310 on the higher side at COMEX. And in terms of the domestic market, prices are facing a stiff hurdle at levels of around 32,350 odd levels. As long as prices are not able to nudge past this level, the outlook will remain slightly bearish. Also, the key risk has been taken off the market in terms of the Brexit uncertainty, because the Brexit deadline has been pushed back to October. So that was a key risk which was driving gold prices, but now that has eased, and so that's going to be a negative trigger for prices. So I'm expecting some more downside to ensue in prices in near term. So I would recommend going short in gold at levels of around 32,150 odd levels, while keeping a stop in places 32,350 odd levels, and one can look for downside targets of 31,850 initially, and in case prices break that mark as well, we are even looking at levels of around 31,700 on the downside.
Okay, so that's the view coming in on gold. Sugandha, I understand you have a sell on copper and you have a buy on crude. I especially want to talk to you about that buy, level on crude, because we've already seen that big rally come in. So you expect more room here?
Yes, I am expecting some more room. The momentum is currently very positive, even though one needs to be cautious at current levels, because we've already seen a stellar rally of close to 35% in crude oil, which has started since the beginning of this year. The major theme that's driving crude oil prices has been the OPEC-led cuts, which has started since the beginning of this year, where they are cutting production by around 1.2 million barrels per day. Alongside the sanctions on Iran and Venezuela has led to a tightening supply scenario. So that has been a major trigger which has actually led to this sharp rally where crude oil prices have soared to a 5-month peak. But then the latest trigger has come in the form of escalating tensions in Venezuela, and Venezuela's output has actually shrunk to a long-term low of 1 million barrel per day. Also, if you see the OPEC's output, it has been falling for the 4th consecutive month and has fallen to a 4-year low. So all these triggers are quite positive for crude oil prices, even though we have seen a brief correction that has come in prices, all because of the rising US inventories, wherein for the last week we have seen a significant build-up in inventories. But still, the outlook remains positive, even though there are still concerns about the demand outlook because of the slowing global economic growth. But then as long as the level of around 42.50 is still holding on charts, I think one should be a buyer in crude oil. In near term also, I would recommend to go long in crude oil at levels of around 44.10, while keeping a stop in place at 43.20 odd levels, and we are looking at higher side targets of around 45.50. However, one needs to be very cautious because one should be booking profits at level of around 45.50, where the rally can stall at higher levels.
Right. Sugandha, appreciate you joining in with your commodity strategies. So there's more room for upside for crude, but gold, she is recommending you could consider selling. So with that, we'll wrap it up on this edition of Commodities First. Thanks so much for watching. We'll see you next week, same time. Until then, enjoy your weekend.